Hey, Bill Faeth here from Build Short-Term Rental Wealth. Today I want to talk to you about the 4 pillars of investing in today's market. Interest rates are slightly higher than what most of you are accustomed to, especially if you just started investing during the gold rush and COVID. If you've been around for a while like myself, I've been doing this since 2015, then I'm used to 7 to 8% interest rates. The number one thing I want you to understand is that your Proforma should be doing the talking. We need to focus on the core 4 components of our investing strategy. We need to run it through a Proforma and really multiples, a good, better, best scenarios. So that's 3 Proformas minimum for every single property. And if you can buy today at 7.25, 7.5, and then think about what happens when you can reposition down to 5.5 or 5 3/4. Typically, if you can get a 1 point decrease in your rate, you're going to want to refinance. So it will create cash flow. So today I'm going to talk about amortization with bank loans, cash flow, taxes, paying down our debt to where we can get principal pay down. There's 4 things, as you can see here in my graphic. This is your short-term rental, single family home investing strategy. And the first thing, what are we all looking for? We all are looking for cash flow. And cash flow is extremely important and the number one thing that we should be looking at and trying to focus on. That's the reason that most of us have moved out of LTRs back in the day, that's long-term rentals, into short-term rentals. Because even in today's marketplace, and there's no question, the gold rush is over, COVID's gone for short-term rentals, but we can still get really great returns. And what I'm seeing, at least in my portfolio, I'm still doing about 6-7 times what I'd be doing in long-term rent. So if there's a property that would be doing $2,000 a month, I'm probably doing on average around $14,000, and it's going to be $165,000, $175,000 a year property. Now remember, I outperform AirDNA and STR Insights 90th percentile by 52%. Most of you, if you're going to be a brand new investor, are going to fall in that 50th to 75th percentile. So you're probably doing half of what I'm going to do. And I always want you to go through and use the top 4. The gold standard for data analysis on revenue forecasting in our industry is AirDNA and STR Insights. But I also use Rabu and Mashvisor because I want to be able to get all 4 when I'm looking at revenue. I need to go and do the research, understand what my skills are, and if I believe I'm going to underperform or outperform a certain percentile, then I'm going to plug that cash flow into a Proforma. If you've never used like a super high quality Proforma, just look down below this video here on YouTube and you're going to be able to get access to my Proforma that myself and John, the Bank Whisperer Hodge from my STR Super team have put together for you. It's the exact same Proforma that him and I use to evaluate single family homes, apartment complexes, motels, all that type of stuff that we're investing into. And we're also going to give you a 30-minute training along with it. So that way you can have the intimate relationship with it. We're going to show you how to use it and really how do you understand, how do you comprehend and apply the numbers that you're getting all the way from DSCR, the debt service coverage ratio, to cash flow. So the Proforma is really at a high level. It's going to be pretty simple. We want to put in our revenue, and then we also want to make sure that we have our expenses. And the thing that becomes really important is that we're forecasting appropriately. So, we need to think about a lot of things that are going to go in here. What are our property taxes? What is the cost for OTA fees? A lot of people don't factor that in. Travel costs as you're going through the setup to be able to go put in food and beverage. Really important. All of those things are things that you're going to end up writing off as you go through the setup process, but you need to think about all of these different components. Pool cleaning fees, snow removal, something when I went into, my first mountain market in Banner Elk, North Carolina, I didn't factor in snow removal. I didn't even think about it. All that stuff's going to go in your Proforma. And one of the big things that we want to end up with is our debt service coverage ratio. And then the other thing, as I get deeper into these 4 things that we need to look at, is going to be our debt pay down. So for me, in today's climate, just on cash flow, I'm looking at 20%. If I can get 20%, and it's in a market that I like, then I'll look at the other 3 components here in the 4. But at 20%, that's pretty much the green light for me to continue to go with. If it's in that 18, 19 range, I'm still going to consider it. If it's like 15, 16, below 15, it's just off the map. There's too much opportunity that's out there. But one of the things that's probably different from me than you is I do this literally every day and I'm patient. My first property I purchased in just outside of Whitefish, Montana, I was looking in the entire state of Montana, western Idaho, kind of northern Wyoming, just under Yellowstone National Park for over 2.5 years until I found the right property to purchase. Did I purchase other properties during that time? 100%, but it was not in that market. Remember, we're buying properties, we're not buying markets. We've got cash flow. The second thing that I'm looking at, and that's number 1, the second one for me is going to be appreciation. don't hold my handwriting against me. Totally spelled it wrong, but who cares? And I'm looking at very specific years. I'm going back pre-COVID to 2017, 2018, 2019. And then I'm going to be looking at 2022, 2023, and the first half of 2024. I am literally taking 2021, 2022, and I'm not interested because I don't want to look at the average appreciation in a market and in the sub-market and then in the bedroom count that I'm looking at during the gold rush. The appreciation was way too high. I'm looking for consistent data. If you're buying any time after June of 2024, then I'd look at what's happening in 2024 for the first half of the year. I'm looking for these averages. I want to know what the percentages are going to be. I just bought a property a couple of months ago. 2 months ago was my last one. And what I was looking at is the average over these years was 5% appreciation. So if I'm buying a $500,000 property and I'm getting 5% appreciation, that's going to be $25,000 a year. That is something I don't want to bank on that. So that doesn't go directly into my Proforma. I'm going to put that on what I call page 2. So I see that as a benefit. I'm working that into my strategy from an investment standpoint, but I'm not banking on it because, we have no idea, especially in a year like this year. It's an election year. God knows what's going to happen with the election, interest rates, the economy, taxes, all that type of stuff. There's just too much uncertainty. But this is a very important data point for me that's $25,000 a year historically outside of COVID. That could have been $100,000 a year, $50,000 a year during COVID. We just don't know. And I don't want to have that factored into my data sets. But I'm looking at that 25 grand. And if I have that $500,000 property and I'm looking at 20% of cash flow, if I do $500K on the purchase and I'm looking for 20% cash on cash, my down payment is going to be 100 grand and about 3 grand to close. So I'm in for 103,000. 20% of that's roughly going to be, we'll just call it 21,000 bucks, right? So that's what I'm expecting. And so let's just say that I'm going to get 21,000 in cash flow. So I'm going to come back over again. And so my cash flow for me, typically on a $500,000 property, I'm probably going to do about $115,000 to $135,000 in revenue. I typically operate at about 40%, but I'm going to downgrade that a little bit so it's realistic for you guys. 40,000K in cash flow. Then I look at my appreciation, and historically that's going to be 25,000. So what else can I look at from a benefit of making this real estate investment, and specifically into short-term rentals because of the short-term rental loophole? I'm going to be looking at the tax benefits. So on the cost segregation study, right, once again, we've got $500,000 property. Let's just say we're buying in the mountains. So, the land value is going to be less than at the beach. So let's say that the land value is 100,000 for easy math here, right? So basically that means that my dwelling value is going to be 400,000. If I can get 20% on that, that's $80,000. I fall into the highest tax bracket. So let's just say 40% for easy math. What's 40% of 80 grand? So it's going to be roughly around 35,000 bucks. That's what I'm looking at. But remember, this is only a 1-year tax benefit through the cost segregation study. It's awesome to come in and get 35,000, but this is only for 1 year. That's why it's third for me, and it is not second. So I don't make investments strictly for tax benefits. I don't make investments strictly for appreciation. I mean, that's the old school long-term rental way. I want cash flow. So I'm going to cash flow 40,000. I'm going to be looking at 25,000 in appreciation, 35,000 in year 1 tax benefits. That's awesome because that's writing off almost 90% of that income is going to be tax-free in year 1. Realistically, if I went to sell this property, I've got 90% tax-free dollars. I appreciate a year later at 25,000. That is like almost 100 grand for me. And I haven't even gotten to the last one. And this is something that a lot of you do not pay enough attention to. And we're going to talk about this a little bit more in depth, is going to be our debt pay down. And the reason this is super duper important on the debt pay down is because the majority of you are going in and looking for the longest amortization and the most cash flow right off the bat, right? So if I take a 20-year and a 30-year AM and we're doing this $500,000 purchase, right, which we're going to put 20% down just for a traditional, and I go to a local commercial bank, I call them the Bloom banks. I'm looking for either banks that already have a relationship in the market that I'm investing into, or I'm looking for balloons that are hanging out in front of a bank because they're going to give you the best deals. Those are the new banks that are looking for deposits, that are looking to do deals that have just opened a new branch, maybe started a brand new bank, and I'm going to go in and I'm going to be looking just for the same type of loans if you're going to buy a motorcycle or a Sea-Doo. Literally, hey, I walk in, I'm looking to make an investment into a short-term rental, looking for a commercial loan, ask them what type of products they have. A lot of them just used to do 20-year amortizations, but now have 25 and 30-year amortizations. So let's just say that we're going to put 20% down over here, so that we're going to finance $400,000 on both sides. And really the big difference here is that $400,000 over 20 years versus 30 years. And remember, there's always different amortization schedules with the banks, but you're probably going to be looking here on 20 years. Right now, let's just say at 7%, let's just say $4,000 a month for easy math. Over here, you're probably going to be around $4,350 to $4,400. So we have a $350 delta between the two right here. I'm taking the 20-year every single purchase all the time because I know that my strategy is I'm going to buy the long-term hold in the market, and then I'm going to be looking to exit and find the appreciation, debt pay down. Well, typically, if I do the difference here, I'm probably going to be paying down an extra $400 to $500 a month as opposed to just the $350 delta. So that's going to give me like between 10 to 12% faster pay down in the first 3 to 5 years. That's why you always want to look at the amortization schedules. All you got to do is ask your bank for the amortization schedules and they will give it to you. So that debt pay down becomes really important, and that's why I'm looking at 20-year loans versus 30 years. I've done one 40-year interest only. I do not recommend this unless you are extremely disciplined, because I actually have an escrow account that I'm putting $3,000 to $5,000 a month of the profit going in. So I don't live off of my rental income, but if you're not disciplined enough to escrow your own principal pay down, then I would not do an interest only. Here's a key factor is I'm making payments twice a month. So we're accelerating paying down principal. So as I look at debt pay down on this, I should be able to easily pay down probably around another $35,000 in principal. If I get 25 in appreciation and I get 35,000 here, I'm looking at an additional $60K in a $500,000 property. We're talking just around 11% increase. So that property should be worth $560. But there's one more bonus that I want to give to you. The last deal I did paid $670,000. That was a full list price. I gave a full price offer. Instead of negotiating them down to around $645, $650, probably what I could have picked it up at, I said, hey, I'll give you full price, but I need a $20,000 seller credit at closing. So that's literally a check that's coming back to me at closing. 67 short-term rentals that I've owned. And I have averaged about $27,000 in seller credits. This is the creative financing that I've been doing since 2018. I didn't do it on my first few in 2015, 2016, but when I really started ramping up in 18, I started taking advantage of the seller credits. You got to have a good agent, a good title company, or a closing attorney to understand how to do this. It's not that challenging, but we can get it done. So multiply this, 27,000 times 67 properties. That's $1.8 million. Folks, I mean, if I had a mic, I would drop it, because this is how I made one investment in my 550, 250 property stacking plan. And I've gotten to $18.8 million in a short-term rental portfolio with about $13 million in equity, generating $1 million a year in net income. I couldn't have done that. I didn't have the cash, just like most of you probably don't. I'm not an ex-hedge fund manager with hundreds of millions of dollars. I can't just go pay cash for everything. So I had to figure out, how do I leverage $126,000 in that first investment and continue to roll it up and get bigger properties and bigger properties and bigger properties. These are the things that become really important to do this. And this is a seller credit. That is something that has generated me an average of $27,000 in cash. I can put this into the ARV, the after renovation budget. That's for the after renovation value. I can put this into my investment account for the next property. That's how we really execute, because we're trying to pay that debt down. We're trying to create equity while generating cash flow. And that's another $20,000 I get to put into my cash flow, right? So if we look at, $60K here between those two, now that's the appreciation. I take my $40,000, but now I am at $60,000 in cash flow. That's $10,000 above the commitment for the 550, 250 plan of net income. Super important. This is not just going and buying a standard property and not going through all of these things. I would highly recommend that you go through this again, take some serious notes, because this is how you're going to be able to generate $250,000 in net income in 5 years or less with one investment. Now, you're going to build enough equity in property number 1, 2, or 3 to where you're going to be able to reposition, either cash out refi when the rates come down, or reposition and sell, and then invest into your next property. And then that's where you'll want to have a really good understanding of where we're at. Maybe we might not even have it. Maybe maybe the cost segregation comes back for the tax benefits to 100%, or leveraging 1031s, or just paying the capital gains on that transaction. But this is how you do the 550, 250 plan. This should benefit you. Don't forget to go down below and download the Proforma Plus training from John Hodge and myself, and make sure you hit that subscribe button. I'll see you guys on the next video. There's one coming up right here.